Welcome to Chameleon Club, helping you become a profitable creature. This is not financial advice. These indicators are merely software tools which attempt to model the price action in a more easy-to-read manner. Although, for the sake of education, the examples shown will probably all work out. However, they are not 100% reliable, and they need to be used carefully. Making any financial decisions based on these materials will lead to account ruin if the lessons on risk management are not understood and actioned. Test all the ideas presented here yourself and be comfortable with them before live trading. There is no rush. If there is a rush for you, then you are not ready. If you are trading the markets with real money, be careful not to use more than 1% of your entire savings in your trading account. First, we need to understand why such measures are necessary. Why do traders fail? The short answer is cutting corners. The levels shown here need to be fully covered before moving on to the next level. Each level provides a foundation for the next. The wise man builds his house upon the solid rock. Tier 1 is learning the basic trading skills, learning how the market adheres to support and resistance levels, how it moves in cycles and waves. Tier 2 is having enough time to make the research for the trade. It also is having the time to absorb lessons learned. This tier includes learning discipline over our selfish ambition. Treat trading like a business. If you treat it like a hobby, it will cost you. Tier 3 is easy to learn, but is often skipped. A consistent strategy requires a consistent risk. Sizing of our position should also encompass the process of building a trading plan. Write out a plan before trading. That way you will at least know where you are stumbling when you fall. Traders fail here if they get a run of losers and they have risked too much of their account. Tier 4 is about finding the right strategy for your unique personality. Psychology is an important aspect of trading. However, it is not very easy to change one's makeup. There are certain things that we must do, but there are some things that we just won't be able to do because they are just incompatible with our personality. If this is the case, we need to be able to quickly adapt what we've learnt in the previous tiers and apply it to a new strategy. Too often traders feel like they have to change themselves in order to fit into a strategy. What this framework will do is give you the tools to be able to try different strategies that fit you, to try them quickly and to discard them if they're not right. Chameleon Club can help you get up to speed on Tier 1 and Tier 2. The indicators automate research to a certain extent to help find possible entries which can then be finally analysed. We send messages to the Discord channels so that it's possible to focus on the correct asset at the right time and time frame in order to reduce the amount of time that you would need in order to find the opportunities that fit. Traders still need to put some effort in. This is not a trade signal service, but rather a tool to help traders generate their own robust signals. Tier 3 is the area where traders master the necessary skill of managing trades in order to maximize performance and manage risk. How trading probability is calculated in order to understand risk. Calculating the stop loss position and take profit levels are in this tier. Managing trades in progress through awareness of price action patterns. Most traders do not realize they need to be less aggressive in order to actually earn more. No amount of software can take that responsibility away from the trader. This is something that must be done on an individual personal level. Do not be fooled by the marketing of the YouTubers in this overhyped environment. Do not covet those crazy gains that they are promising. Prove you can make money on paper with small accounts first. Tier 4. Strategy fit. As previously mentioned, do not try to be something you are not. We offer many strategies which you can learn and test for yourself in order to find one which suits you. Notice, there's a big difference with what we're offering here. We're not trying to get you to suit the strategy. This will lead to a friction, which will not be helpful to you in the long run. If none of our strategies work for you, simply let us know what is going wrong. Let us try to resolve it for you, and if not, perhaps we can help you move on to something else. How then to be a profitable trader? Use our indicators to find entry and stop positions. Practice using staggered stops and profit slicing. Make sure you're making profitable decisions with paper trading accounts before moving on to real money. Make a trading plan for the period ahead and evaluate before continuing and setting a new goal. As R. Milner says, every successful trader has a written trading plan, and most of the unsuccessful traders has no trading plan. If you want to be a successful trader, have a written trading plan. We can help. We have a trading spreadsheet which you can use, which starts you to think about how to set position size and take profit levels. There's also the facility to keep track of the signal trigger, so you can start to see patterns in your trades, and hopefully by taking lots of small profits, you will find that the losing trades are in the minority, and therefore analysis of those is legitimate as opposed to just some variance of the mean. Reassess and confirm your position sizing and risk-reward ratio is correct. Position sizing. Master risk or it will lead to account failure. Master risk or it will lead to failure. Very important to keep risk size the same across the strategy. In order to reduce the risk of account ruin, limit the position size of each trade to be 1/3 of 1% of the account. There is mathematical research which supports this seemingly small stake size. If you're interested, look for Kelly Betting or Kelly Criterion, and you'll find more information, summaries of simulations that have been done in order to find the optimal, safe way of building an account. Do a few sessions of paper trading to get into the hang of trading in this way. I can't stress that enough. You have to prove to yourself objectively that you are able to follow the process through without risking any of your capital. And once the trade is moving away from your position, then move the stop to break even. This is an egg and spoon race, not a sprint. Don't worry if 1/3 of 1% does not sound much. This leaves plenty of scope for up to 3 bullets per trade idea. If you are trading on the 15-minute chart, there should be 1 trade per day. On the basis of aiming for a 1 to 1.5 risk-reward ratio, this should generate approximately 1% per day as a feasible target for your first trade plan. So now we've covered the basics, we've covered some of the disciplines that are necessary, some of the things that we will have to put into practice, and that are non-negotiable in terms of becoming a profitable trader. We can now look in detail at the tools themselves. Chameleon. This is an indicator which you can add to your TradingView account. It changes the colours of the bars based on mathematical sequencing to identify trends and relationships between price action. The chameleon context is another indicator. This is a descriptive rather than a predictive tool, hence is not accurate enough for finding trade setups alone, but rather acts as a filter for chameleon. It uses percentile ranking as its basis. And the third tool, as mentioned already, is the position size calculator. This is a necessary step to keep us on track, to know what our path is, to plan our path beforehand, and to enter very carefully each trade as it progresses. The concept of profit slicing is something that is very important for successful traders. Being able to constantly take profit off as the price is going in the direction you want will just allow you to continue to grow your account slowly. And this is what we're aiming for here. Remember, the larger the profit target, the less likely it will be reached. It's far better to have a high win rate with a very small gain in order to build confidence. We keep that win rate high by moving the stops to a break-even position as soon as candles start to move away from the entry level. In this slide, we will see our first strategy test: supply and demand. In order to do this, you need to have the chameleon indicator installed. You reset your paper trading account and use amounts which match the amounts you are likely to be starting off with. Second thing to do is to enable the supply and demand gold circles and the VWAP and averaged VWAP levels. These are guides to show the places where price is likely to react. If price has not yet bounced from the current gold circle line, which is drawn by the indicator, set a limit order at the gold circles. Bear in mind that these gold circles are modeling supply and demand. The supply and demand trading methodology purports that this supply and demand level, as it's touched the first time, will cause some kind of reaction for price, but it only works the first time it reaches this level. And it doesn't work every time, but there's a high probability chance that it will work the first time, and sometimes the second time, but we're only interested in the first time. Subsequent times may be useful later on as we're managing other trades, but that's beyond the scope of this test. Point 5. Set the stop loss away from the supply and demand zone. And you can use the low of the last yellow candle for a long. Step 6. Draw a risk-reward rectangle using the TradingView tools to help set the take profit level. Only risk 1% of your trading account on each trade, and this can be done with 3 1/3% bullets. In this case, all 3 bullets can be fired at the limit level. Step 8. Experiment with doubling your size to 2% if the VWAP bounce provides confluence. If that doesn't make any sense to you, then just skip past that stage. Number 9 is to repeat this process 10 times. The screenshot on the right is from the settings dialog box. In order to view the supply and demand gold circles, be sure to untick the Hide Supply Target and Hide Demand Target options. Let's look at an example of this. Here is a section of the chart which has just printed a gold circle, which represents the beginning of a marker of a supply-demand area. As more gold circles are printed, we are waiting for a move away from this area so that we can set a limit order for the first time price returns to it. Here, price has returned to the level and the limit order for the long is filled. The stop loss is calculated based on previous price action. This is calculated before placing the limit order so that the correct position size can be set in advance in order to manage the risk consistently. And then the supply and demand principle pays off again. Price moves away from the demand area. Preparing for a supply and demand trade requires some basic drawing skills using the easy-to-use TradingView built-in tools. Chameleon provides the gold circles which tell us where to draw the areas of possible supply and demand. They are not using actual order data. This is a mathematical model. The indicator will update the chart with new levels which are most relevant as time progresses. And this means that sometimes the current level needs to be imagined by extending the lines to the right. Old levels still carry weight, even if they are no longer being printed. Watch out for that. Old gold levels are sometimes useful as targets and stop losses in future trades. Practice drawing the gold rectangles onto the chart to show where the supply and demand areas are in the current price history. Use the local maxima and local minima to set the edges of the zones and see how the candles move away from those areas rapidly to set the point of exit from that zone, which will eventually become the area that is retested. The second fitness test, strategy fitness test, is the breakout trade. Once again, we need to have these indicators added to the chart. We reset the paper trading account, and then in this strategy, we're waiting for an uptrend on a higher time frame, something like the 60-minute or 1 hour time frame. And we're looking for a green triangle above the bar, which uses the bar to bar function of the indicator. The bar to bar function is simply measuring the relationship between one bar and its predecessor to see whether there is any uptrend or downtrend. So by looking on the higher time frame for a confirmation of an uptrend, we can now turn to the lower time frame and be more sure that the movement that we're likely to see is in the up direction. But we must wait for the entry signal on the lower time frame. We wait for the second green candle which breaks above the first, and we can use the chameleon context to add an additional layer of insurance, if you like, to show that the momentum that we are trading with is consistent with a percentile rank analysis. Rather than rushing in with a market order, we can place a limit order at the open of the first green candle. This may mean we miss some trades, but there are plenty. Set the stop loss somewhere below the low of the first green candle in the sequence and draw a 1.5 risk reward rectangle to set the take profit level. Remove the limit order if it is not filled within 3 or 4 candles and wait for the next trade. Only risk 1% of your trading account on each trade. Repeat and send your completed 10 trade spreadsheet to us for feedback. Note that instead of waiting for an uptrend on the 60-minute chart, you can join the Discord and track the channel announcements, which are automatically notified by the Chameleon algorithm, which is running on the server and is sending out announcements when there is a change in the overall trend. We have set this up to actually use the 55-minute chart. This helps us get ahead of the market, which is waiting for the 60-minute to close. And we like 55 because it is a Fibonacci number, and the Fibonacci numbers have great significance in understanding chart patterns. Note also that if you have an account which supports custom timeframes, it is recommended to use the 13-minute instead of the 15-minute. However, the 15-minute will suffice. In this example, we show a way to find the trend yourself. The same strategy works in reverse when price is heading down. On the higher time frame, we look for shorts. You can detect the trend yourself by using the bar-to-bar function on a higher time frame. This shows the direction of the trend with a faded triangle above the candle. Red for down, green for up. In this example, as shown by the first grey circle, it shows that the 4-hour is neutral. This is neutral. There is no obvious trend. The candle is grey. The 2-hour shows 2 red triangles. That's what you see here on that zoomed in section. Hence, we are only looking for shorts in this instance. The trend is your friend. Perhaps you're intrigued by these extra colours that you've seen in some of the examples. Well, take a step back. If you squint your eyes, you maybe cannot see this chameleon in the trees. This is how a chart without chameleon indicator looks to me. Trading is hard. It still takes some effort to analyse and to see what the chart is saying. But with these colours added overlaying on top of the chart, reading the chart becomes something that is intuitive and instant. It is possible to see clearly the trend direction and trade setups so that we can spend more time doing more important things. So, without further ado, when price is in an uptrend, the candles are painted forest green. You can consider to market enter long on the break of the forest green candle. Usually, a limit order is best. If the forest green candle is an engulfer, that is, it covers the range of the previous candle, then set a limit order on the retest of the latest area of resistance. Important rules to learn. After a valid trade has ended, it is usually best to cool off before entering in the same direction again. In this example, price did not break the local high, the wick of the grey candle, so this cannot be a breakup. You should look here at the start of the green candles as the beginning of the wave up, and not consider this a start of a new wave after just one grey candle. So there'll be no trade in this situation, since though we can see that the second green candle would have gone higher than the previous green at some stage, it failed to break higher than the candle before that. Red candles indicate that price is in a downtrend. Consider to market enter short on the break of the red candle. Down moves occur faster and deeper than up moves. If the red candle is an engulfer, then set a limit order on the retest of the latest area of support. Maroon candles are price pivots with a downside bias above demand. Therefore, these are usually good places to enter short. Their high is usually the local top. They can act as range markers before a tradable move down. The maroon colour has been chosen to indicate the strongest expectation of a down move within the software. Yellow candles are the first condition needed in order for a confirmed trend reversal. Hence, there is an option to set an alert for when a yellow is painted to prepare for a long. The low of the yellow helps us find the safe place to place a stop in a long trade setup, especially if the yellow is part of a cluster of candles which make a local low. The high of the yellow is also a useful area to move a stop to in a short trade. As well as the yellow VWAP lines, which you will see added to your chart, the yellow candles seem to provide a useful measure of dynamic support and resistance. It may help you remember this invisible watershed by thinking of the two yellow lines painted on roads. Staggered stops help prevent us from getting entirely wicked out of a position, whilst also keeping control of the risk. More safety means less reward. It is up to the trader to find the correct levels based on their own strategy testing. Avoid physical stops if possible, but as you are learning, you will need to use them. If you find that you are not able to execute mental stops, then physical ones will be necessary. But do not make the stop too close to obvious support resistance, lest it be flushed out by market makers who know where your stops are. Usually there will be 2 or 3 places to enter a trade. 3 should be the limit in order to reach a position size of 1% in total. Notice how the yellow with the low near the local minima was chosen for one of the stop limits in this example. In this example, it should have been realized that the orange box of demand would get a touch back if price went close enough to it. And so the position of the low of the yellow in this case is incorrect. These 2 chart diagrams show how it is possible to get 2 stop loss positions by checking for the low of the yellow candle on the current time frame and a higher time frame. Risk reduction warning. As traders, our number 1 job is to manage risk. Chameleon helps this by giving clues about when to tighten the stop loss. A red triangle down shape above a candle suggests that the trend is not so strong after all, and that the stop loss should be moved up to a tighter position. Orange candles help establish a local pivot range. When a bar closes outside the range created by this candle, a big and sudden move in that direction is expected, which in turn may lead to a retest of that range. Sometimes, strong uptrends will paint orange pivots, and these mark out the support. There is some sideways action for 1 to 4 bars, and then the pivot range breaks up. Other times it breaks down and offers a good stop out point in managing uptrends. Hence, orange candles are useful as a way to close longs, certainly to profit slice. However, check the higher time frame. Check the contextual filter. Slicing is a method outlined in The Art of Execution, an excellent book which looks at all the decisions of some of the world's best money managers. The connoisseurs were a group of investors that ran their winners, taking small profits along the way to enjoy like a fine wine. This method can be great for one's nerves, as profit is not profit until it is banked. De-risking on the way up means that should there be any bad price action to come, we have already taken gains along the journey. Olive candles are also a useful trigger to close along, in order to get a better entry at a lower price maybe, nearer to local resistance. Treat these similar to pivots. They also provide a clue that there is substantial downward price pressure. Notice in the chart diagram, an olive candle appears as a doji. This is quite common. The next candle is orange, and the downward momentum is clearer. Price closes below the orange, indicating the next move to be down. Setting a short limit order at the low of the orange would be an easy trade to make. Trailing the stop down towards the high of the first yellow candle may or may not have got hit, depending on how tight it was placed. But regardless, a profitable trade idea was presented. A good tip to keep in mind: market makers are constantly trying to grab liquidity by spiking above the high or low price of a region in order to generate the momentum to reverse the price in the opposite direction. The first re-entry long signal would have been at the close of the confirmed reversal pattern finalized by the forest green triangle. This and the next two such sequences would not have initiated a big move, but may have given some profitable opportunities. But crucially, the move back up through the original olive pivot zone would have been captured. Pivots with an upside bias are shown with magenta candles. These help establish a local low. When a bar closes outside of the high of this candle, a big and sudden move in that direction is expected, which in turn may lead to a retest of that range. Reversal candle patterns at or just after the magenta candle make good risk-reward long entries. Hard physical stops are essential here, since these candles are like firecrackers and offer a lot of potential for big moves either way. Be extra careful and do not trade them while you are still learning the basics of becoming a profitable creature. Staggered stops may be helpful here too. Experiment with these by going back through the charts to find examples of magenta candles and learn from how they acted and what other telltale signals could help you to make the right choice. Additional confluence from the golden supply and demand circles, chameleon context, the yellow VWAP, and higher time frame chameleon tail analysis will help validate these moves. Extra research in this area is required, so please do share your findings in the Discord. If you do have justified confidence in taking these trades, move the stop to break even as soon as possible and then let them run. Local Maxima. Teal candles indicate a high in a sequence of 5 candles. They predict a downside reversal of 1 to 3 bars. This is because price moves in waves. And when it moves up, it needs to come back down in order to recharge itself. This is not usually an entry candle, but a possible long exit until the trend is clear again. Again, another place for profit slicing. A sea green candle indicates that the uptrend is weakening. Not all the criteria for a forest green has been met, but there is still some lingering upward momentum. A grey candle signifies no clear trend. These candles provide further profit sliding prompts. Price breakout to the upside or stop runs are indicated by lime candles. Now, both of those outcomes are polar opposites to each other, so these need to be handled very carefully. Lime candles may be a sign to get ready for a long entry, but they also may be a sign that a stop hunt is in process by market makers. Lime signals that the trend has gone from being in a downtrend to an uptrend in just one candle. This is unnatural and should therefore be quite rare. One possibility is to try a limit long at the open of the previous candle once you deduce a stop hunt is not in play from a higher time frame. The pink candles are the inverse of the lime greens. They are most useful for informational purposes. They signal that the trend has gone from being in an uptrend to a downtrend in just one candle. They are similar but in reverse with the lime. A limit short at the open of the previous candle can also be a high risk reward entry. These two pink and lime green candles can be used to exit bad trades. But if these are being used to invalidate a trade, wait for the retest as shown in this example in order to exit at a more optimal level. Because the following candle often spikes up above half the distance of these big directional candles. So a little patience and a little calmness will allow you to, in this example, leave the trade at a break-even point. These patterns are the easiest to learn for entries for longs and shorts. This does not mean we should FOMO in. If the trigger candle is large, such as an engulfer, limit orders should be set at areas which the chameleon indicator should help identify, such as retests of pivot range, retests of VWAP levels, retest of other areas which the indicator will paint. It will also be helped by a background color change underneath the bar on the chart, which is the chameleon's attempt to try to present such setups. However, it is much better to learn to be able to do this oneself. This slide provides a reminder of where to place stop limits positions for longs and shorts. The low of the yellow, the top of the first red, or the top of the maroon candle. Help is at hand. You can become a profitable creature at the Chameleon Club. Why not join the Chameleon Club Discord channel? From here you can request the chameleon and chameleon context indicators and check the announcement channels which are receiving continuous scanning from the chameleon algorithm in order to identify the time to look for entries. Simply enter that URL into your browser and you will be directed to the Discord channel.